Okay. We'll be live in. So we're live. All right. Welcome to another episode of whatever this is. So this is just a weekly stream. We don't even have a name for this thing yet, too, but
Yeah, I
whatever.
know.
We'll just
Mm.
let's
We're
keep
talking
doing it.
about economics, wealth, money, investment, and I think that's cool. We'll find a name later. It's not the most
Economics,
important.
wealth, money, and financial freedom.
Investing,
Did you say?
financial freedom.
Investing.
Mm-hmm.
Yes. So that's what this weekly live stream is all about, basically. And on today's episode, very interesting conversation. We're going to be talking about Ponzi schemes. In the
Mm-hmm.
words of Kweku the Traveler. Of course, who will never fall victim hands in the air. Of course, obviously, there are a lot of people who have not fallen victims, but yeah, there's
Yeah.
still quite a large number of people who are falling victims as well. So that this is why it's very necessary, especially Nigerians. I can't speak for other countries. I really don't know what the culture is like or their attitude is like towards Ponzi's, but
I
in
think
Nigeria, it's a
everywhere. I
menace
think I think everywhere in the world. The
everywhere in
word
the world.
Ponzi scheme. Ponzi is Charles Ponzi, an Italian American, is the one that invented Ponzi scheme. So Ponzi is actually
Ponzi's.
someone's name. So it means that it actually
Oh.
came in from the United States.
From
So they
not
have experienced
okay,
it a
okay,
lot.
a lot
So
there. Okay,
mm,
interesting. So, anyways, data or statistics shows us that tens of billions of naira is lost by Nigerians to Ponzi schemes and other unsustainable investments every single year. And
mhm.
you said something that you believe that it's because most people aren't armed with the appropriate knowledge or different things. But anyway, we're going to find out in today's conversation why is it that
Mm-hmm.
people fall for this. Number two, what can we do to avoid being victims? How can you spot? How can you know that, oh, this thing is an unsustainable? I think I even prefer unsustainable investment. I prefer that phrase, because even some things that don't look like Ponzi, they still end up going
Yeah.
down the drain. Agri
Yes.
tech, for example, it didn't come
Mm-hmm.
like it was Ponzi because, I mean, for God's sake, people claimed to be farming, but at the end of the day, we see what happened at the end of the day. So, yeah, we're going to put them all together and find out how to spot one, how to know that this is not. So, yeah, the floor is
Well,
yours. Why do people fall victim?
I think that people fall victim primarily because they want to make money and they want to make money fast. So, what a Ponzi is basically what you've termed as an unsustainable financial scheme where you are told to invest in something. The guy who started it in the 1920s, that's the Charles Ponzi guy in America, used to tell people to invest in, I think, milk coupons. So those coupons
In
now,
what?
they don't really coupons, coupons.
Okay, funds. Okay.
Yeah, coupons. So those coupons don't really mean anything, but you're just
Mm,
giving people a reason to trigger their want for gain, financial gain. So the idea is, oh, invest in these meal coupons, and after 3 months you get 50%. After a month you get 50. The percentage are usually very high. So what people are hearing is not what you are investing, is the percentage. And then the
okay.
coupons, people don't even ask, okay, these coupons, what are they good for? Why am I, if I
Mm,
don't get my money back, what can I use them for? You can't use them for anything, right? So the reason why people fall for Ponzi schemes is simply because, I mean, to an extent, you could say it's not bad. But on the flip side, I think there is also the side of greed,
greed.
where a lot of us just want money. There's also that side, yes. There's a side of no knowledge, there's a side of, okay, I feel this is very high, but I can just get in and get out. People also, I think it's those two reasons. And then,
Okay.
so there are basically two types of Ponzi schemes. There is that one, like the first one I mentioned, where the so-called investment you are making is not in anything valuable, right? Then there are others like the agri-tech schemes you mentioned, where they present you with something seemingly valuable or something valuable. Some people do it with gold, like the Swiss golden thing. Then this whole agri-tech schemes. But what makes it Ponzi is the rates they are offering you, the very unrealistic rates, that they're offering you, rates that are unsustainable in the first place. And then
Okay.
the sister to Ponzi schemes are actually pyramid schemes. So the difference between Ponzi and pyramid, the rates are still high. For pyramid schemes, you are told to bring other people, to bring other
Okay.
people. So pyramid schemes can be built around physical, real products, but the scheme is still pyramid, or in some cases Ponzi. Depends on how they arrange it. So in a pyramid scheme, you
Mm.
are usually told to bring someone else to make money, right? But yet the rates are unsustainable. If everybody finishes bringing people, the bottom of the pyramid will not have anyone to bring who
Will
is
not have
interested,
anything.
yes, to bring. So that's where it usually fails. So you've seen a lot of these companies that usually sell health products. The products are real, no
Mm.
doubt, but overpriced so that they can keep paying their people. At the end of the day, after a couple of years, the people who are willing to buy that product or join the marketing train, would run out of those people in a region, and then there will not be anyone to bring in anymore. So they
Right.
basically just use people to sell their products for a while, make so much money, and then introduce the product into the market without directly telling people that that's what they are doing.
That's what
So
they're
all
doing.
these are,
Okay. Okay.
yeah, all,
So
all these are
just a
forms of
very
Ponzi
short
and pyramid schemes. Yeah.
Ponzi. Okay, just a very short recap now. We've covered two major reasons why it is that people fall for Ponzi's. So number one, you mentioned greed. Um,
Yes.
Number two, you said wanting to make money at a very
Yes.
high rate. I think that still falls under greed. And then you also said ignorance, like generally not
Ignorance.
knowing
Yeah.
that okay, this
Uh-huh.
thing is not greed. This thing is not real. This is not a sustainable investment vehicle or
Yeah.
sustainable investment project. But then you also talked about saying there is the one that's outright Ponzi, that you
Mm-hmm.
know that these people are dealing in things that are just not valuable. So at the end of the day, self, you can't even like get any value, just like the meal coupons that the
Mm-hmm.
father of Ponzi originated. But and then
Exactly.
there's the second one where people throw something valuable at you. So you're not necessarily seeing. I mean, it's I think those ones are actually more difficult to spot because you know that this
Yes.
thing they're talking about has value. For example, that Swiss golden one, everybody knew
Mm-hmm.
that gold had value. Gold was valuable. Do you understand? So at the mention of the name gold, everybody just feels that there's this credibility around this
Yeah.
business. Do you understand?
Yeah.
So in those kind of situations, how can people really then sit down and say, okay, how can they evaluate that this opportunity is going to land me in the trenches, as they say?
The rates they're offering, the rates, and
The rates.
there isn't yes, the rates. So there isn't a fixed rate. You compare the rates to the rate at which the banks in that region lend money. If it's higher,
Okay.
the higher the difference between the rates they're offering and the bank rates, the faster the scheme will fail. So here's why. Since they are using the currency of that country to carry out that scheme, to participate in that scheme, there's a limit to how much of that currency is available to continue to carry participate in the scheme. And then there is also a limit of the rate at which new currency is created. So, for example, there's a rate at which more naira is printed or created, say, every quarter or every 6 months. There's a rate, right? So when the and then the monetary policy, the rates at which the banks are giving out loans, then the rate at which the banks themselves are also doing things like treasury bills and bonds. Anything that is much higher than that rate and is supposed to be, especially monthly, the frequency also matters to monthly, then just know that it's not going to be sustainable um, in the long run. So that it's basically the rates you use to calculate it. So the rates might be different in Nigeria than it is in the US, because in the US you have a lower inflation rate than in a place like Nigeria. But once you get the inflation rate, get the rate at which banks are lending out money, then compare. So the question I usually tell people to ask is, when they tell you to come invest in these schemes and promise you, say, a return of 50%, let's use 50% per annum in Nigeria. That's really not an investment, right? You are loaning these companies your money. It's a loan. So then ask yourself, how come these people are willing to give me 50% in 1 year when they can loan that money? The highest rate for a Nigerian bank would be 30%, like the very highest. So I don't need to take the money from the bank and pay the bank 30% within the same time frame. Why come and give me 60%? Do you think it's because they love people? So the answer is no. Yeah, I hear some of those people who start these schemes give the excuse that, oh, getting loans from banks could be a bottleneck. It's really not a bottleneck if you think of it in some way, because the banks need to be sure you know what you are doing. All the collateral and the things they're asking for is valid so that they don't throw money away too. So, and then there's also Bank of Industry. I think there's this Bank of Agriculture also. And these are banks that the federal government set up to give money out for very little, interest
Interest rates.
compared to the commercial banks. And then the criteria for getting these loans are not as rigid as those of the commercial banks, because it's
Yeah, the bar is
virtually
usually lower.
it's 9%, so they're just giving it to you at the inflation rate. So it's not, the government is not doing it to really make any money. It's just to help economic activities. So why don't these
Mm,
people go for this kind of loans? So those are not
okay.
investments, they are loans. So the rates usually is what you look at.
Okay. So when the rate is unusually high, higher than what
Yeah.
obtains in the general economic scale in that country, then that
Yes.
should ring alarm bells. So, but
Yes.
then what if the people who create these schemes, they are quite smart. You can give it to them. Some of
Mm-hmm.
them are quite smart. What
Yeah.
if they then come now with regular, seemingly regular rates? It's
So the next
possible.
step,
Some of them can actually
yes,
do that.
it's it's possible, but then the next step, if they want to do that, then it becomes really not attractive for, again, the investors. The investors would rather take their
Mm,
money and go and play something safe and fix it.
okay.
Yeah, so you get, so fine. um um I don't think I'm actually also saying that some of these schemes or some of these businesses, let me put it that way, are not real. But if the business has a
Mm,
track record, has been around for a while, and then the rate is reasonable, then you might consider, investing in them, because like I said, these are not investments. You're actually giving them a loan. Once
a
there
loan.
is a loan, really, to be frank. Those things they present as investments are actually loans. So they are saying
So why do
loan
you call
me.
them loans, really?
Why I call them loans is
You say
because
they're not
that's what loans.
investments, they're loans.
You don't own anything. In an investment, you own something, you own equity, or you own a portion of
Okay.
what you are investing in. But in this case, I mean, if what's the difference if a company goes to a bank and says, I need 50 million naira, and the bank would then say, okay, you give it back to us at this rate over this period of time. That's
Mm,
a loan, right? What makes it
exactly.
a loan is simply because there is the capital, there is an interest rate, and then there's a time frame. That's exactly what it is when they come and tell you to give them money, but they just represent it and call it investing. It's not investing, really. The
Okay.
banks don't call it investing, for example. A bank that gives you loan does not tell you they're investing in you, right? They tell you to
Yeah.
come and take a loan. So these companies are actually telling you, asking for a loan and calling it investment. It's an investment when you own portions of that entity. And in this case, you
Okay.
don't
I
own
get
any
get
portion of
that
the entity.
now.
Mhm. So
Okay.
that's that.
I think that answers the question. That answers the question. So the we just now just touched on the why you are calling those type of investments loans, not
Mhm.
necessarily investments. So
Yeah,
the earlier we see them as loans, I think the better for us, because then
exactly.
maybe calling it a loan then makes people to actually do due diligence.
Diligence, yes.
Do
Exactly.
you understand?
You're getting
Say,
the trick now. They call it
Mm.
an investment so that you don't even like I've said many times. All of this has to do with financial intelligence, being very conscious of what's going on and how people can use words and presentation to deceive. Simply put, is deception
Mm.
and creates an impression that is not. So yeah, basically,
Mm.
the more accurately you think of what you are doing, see it for what it is, the better your due diligence will
The
be.
better your due diligence. Yeah, I totally
Yeah.
agree with you. But I think, is there any other thing you think we've not explored in this topic? Because I think you've very well explained it, quite very
No,
well explained.
I think for this topic, I think the things we've said so far, things I have said so far,
Mm.
cover the topic fairly well.
Covers it.
But again,
Okay.
one other thing I think I'd like to add in closing is that people should always, if you are listening to this, you should always approach finance from economy first. And what I mean economy first is always ask, this thing I'm doing, how does it serve, or I'm putting my money in, how does it serve people? What are they doing to serve people? And at what rate are they making money? In reality, is it sustainable? What are the risks involved? If it fails, what next? So those are the questions you should ask before you put your money in anything, or some of the questions you should ask. So I would
Okay.
encourage everyone to always approach it from the value
From that
point of
angle.
view. Yes.
Yeah, I totally agree with you. Thank you very much. And in case you're watching this after this live stream, you'd like to connect with us, our chat link is in the description below, and the link to the Wealth and Investing Exposition
Investing
course
Exposition.
is also in the link
Yeah.
below. All right, thank you so much, Atisa, for doing this today. I'll see you
Thank
again,
you.
same time
Uh,
next week. All right,
Okay.
bye.
Bye.